Hello, thank you for having me, everybody. I hope you had an enjoyable morning. I'm going to start by telling you that historically, when inflation has been just 2.5% or higher, bonds and equities become positively correlated. So they move in the same direction at the same time. Now, that is not something that we need to worry about if the inflation that we've just experienced truly is transitory, as lots of people like to describe it, but is a pretty big deal if it's not. And what I want to talk to you about today is why I think 2% is probably now the floor for inflation rather than the ceiling, which very much was the case in the past couple of decades, why that matters, and what we can try and do about it. So, next 20 minutes I'll spend with you. Let's give it some inflation context. What do I think the future holds? I think we're in a new inflation regime. What that means, sneak preview, I think traditional asset allocation needs a slight rethink. The kinds of questions we as investors probably should be asking ourselves and the types of assets we should be looking at, because I want to present to you some solutions, not just a problem today. And then I'll finally touch on what we're doing about it in Ruffer Investment Company. So let's kick off with inflation regime change. Now, despite the views of many investors that I speak to week in, week out, and probably a lot of people in this room, I think it's still pretty fair to say that when looking through the lens of asset pricing, investors are very confident that inflation is now dead and buried. And perhaps in the UK, headline inflation hitting 2% earlier in the year really was the nail in the coffin. But is it? Very topical for Halloween as well. Whatever the next few years hold, we at Ruffer strongly believe that we're not going back to the steady sea state that we had sort of post-Cold War, pre-COVID, and that actually the next few years are likely to be a lot trickier. And that's because you've got huge waves arriving in our economy, in our society, and in markets, all at the same time that we think are driving us towards a much more inflation-prone and volatile era. Now, that includes lots of uncertainties, things like changing world order, and we really don't have to look much beyond the headlines to see that. Debt dynamics, swollen fiscal deficits, the fact that the US government has already spent far more this year servicing its debt than it has on its defense spending, and we all know how topical that is. Migration and demography, the challenging of aging Western populations, huge population growth in developing markets, and the movement of people and the link to climate change there. Technology, whether we get that AI productivity boom or not, I think it's guaranteed to be disruptive either way. And then, of course, there's an inevitability of the energy transition, trying to reduce our consumption of fossil fuels without lowering GDP growth and living standards. I don't think that's going to be a smooth journey. And then last but not least, the return of big government and fiscal dominance, and that's pretty evident again in the politics today. It's a real smorgasbord here of inflationary possibilities. Clearly, I don't know where inflation will get to, exactly where it's going, but I think we can say there is at least a degree of risk that it is anything but transitory. And if history is a guide, there are more waves to come. This chart is showing you US CPI percentage year on year over 3 different periods, the 40s, the 70s, and the 2020s. The x-axis is showing you a 10-year period, the 24 months, so 2 years before inflation peaks, and then the following 96 months or 8 years. It illustrates that inflation has a tendency for resurgence, and that happens because central banks find it difficult to maintain sufficiently tight policy, and they don't recognise inflation enough as a problem. Now, that starts to make that 50 basis point cut from the Fed a few weeks ago, particularly in light of the hotter than expected CPI print yesterday, looking quite interesting. Now, I don't necessarily anticipate inflation going back to sort of 2022 levels, but we do believe that inflation is very likely to be more volatile. There's certainly risks of further waves. But even if we do get all the way back to 2% in the US or the UK, I do think it's unlikely to just stay there. I do think that 2% is now the floor, not the ceiling, and that is a very, very meaningful shift. Because up until 2020, the past 3 decades, we really have not had to worry about inflation as investors because we just saw nothing above really that 2% level. But I think 2022 took us into a decisively different world, and you could argue the impact of that hasn't really yet fully been felt. Because what we've got is equity markets, especially in the US, at all-time highs. This chart is showing the S&P 500 as the dark green line against various valuation levels, from 14 times to 24 times forward PE. We're currently about 22, 23 times, so well above its historical average of about 15, 16. What happens if we get another inflationary wave? And there are plenty of candidates for that, I think. You've got some pretty robust economic fundamentals, especially in the US, maybe an oil price spike from the geopolitics, a China stimulus now, maybe a post-election stimulus or fiscal splurge in the US. Now, given all of those possible catalysts, these valuation levels, I think it makes this message even more pertinent today, because it's arguably a great time to start top slicing some of those gains, the things that worked very well in the old regime, taking some profits, things that worked well in the past, and better prepare for the future. So, if we're agreed, we probably don't want to experience again what many portfolios did in 2022, a year when the two major asset classes, bonds and equities, fell in tandem, and we think there's at least a risk of future inflationary episodes. We want to ensure, of course, that portfolios are going to be well protected. So how best should we be thinking about that? Now, this is clearly an oversimplification, but it sort of illustrates the traditional approach to asset allocation, one that has worked very, very well, and we can pretty much boil it down to these two key things. Firstly, a focus on capital growth, which is often solved with a large allocation to equities, and then, of course, meeting people's income requirements, often from fixed income, so using bonds, maybe also some income alternatives, infrastructure, real estate, maybe some of the things that you've been hearing about today. Now, in the old regime, that 30, 40-year period, absent inflation risk, those income assets also solved for diversification. Bonds protected when equities sold off. 2022 revealed that bonds are not reliable in an environment of high and rising inflation. And many of the income alternatives, which were thought potentially to be able to offer some diversification, actually just proved themselves to be very interest rate sensitive, really just other forms of duration in disguise, and often less liquid and more cyclical forms of that. Investors discovered in 2022 that higher inflation, it's very difficult to build a balanced portfolio with just growth and income assets, and a lot of people were lacking a truly uncorrelated source of returns. And this chart, I think, just highlights how meaningful that shift has been, how stark that change was, moving from a world where the bond-equity correlation has been pretty negative over the last 2 decades to one where it's now positive. So this is showing you the 2-year rolling bond equity, the 12-month rolling bond equity correlation in the US. Below the line, they're moving in opposite directions. Above the line, they're moving together. That is even more stark when you look over a further 100 years. So if we roll that correlation back even further, it tells us that actually that is far more common than not. That typically bonds and equities do move in the same direction at the same time. And the anomaly, arguably, has been that 30, 40-year period and the ease with which investors have been able to diversify when inflation has not been hanging around. And that's why potentially the current framework might not deliver as much diversification as investors once thought. So it's why we conclude that you do need to think about things a little differently now. Again, oversimplification, but perhaps we need to start thinking about alternatives in their own right, rather than wrapping them up with income assets or relying on different forms of duration to play that role. Growth and income buckets certainly tick a lot of boxes, but we think a slight shift is required to deliver those uncorrelated returns, perhaps, in the coming years. Now, in terms of the characteristics, ideally, of those alternatives, liquid would be good. That allows investors to be nimble, therefore not just to protect in the difficult years, but also capture some opportunity that we think this higher inflation world will bring with it, given perhaps the volatility. And as I say, the good news is that maybe now is a good time to make that shift. So I want to spend the rest of the time I've got with you on what the data shows the solution to be. Now, not coincidentally, Ruffer hired a head of investment strategy in a gentleman called Tun Dreismer about 18 months ago, and he co-authored one of the seminal academic papers titled The Best Strategies for Inflationary Times. And I think his findings, and why I want to share them with you today, can be a very helpful input into decision-making when thinking about how to achieve diversification in an environment of higher inflation. Now, Tern and his co-authors looked at 100 years of history across the UK, the US, and Japan, and they looked at which asset classes helped and which hindered in different inflationary regimes. They described 4 different inflation regimes, which I've plotted here, and I'm going to talk you through each, and which asset classes work and which lose you money in each one. They defined those regimes by looking at both the level of inflation, so whether it was above or below 2%, which is one of the axes here, and whether inflation was rising or falling, so the direction of inflation. Now, if we start with the bottom 2 quadrants, deflation and reflation, it's where that level is at 2% or below. And so this is what I'm arguing the old regime is and where we have been. And that's where you've got a ceiling of 2%. And if we start with reflation, that happened about a third of the time over that 100 years of history. So inflation is low, but it's rising. That means typically the economy is growing, but it's not overheating. You haven't really got an inflation problem. You've got strong performance for your growth assets, and income is okay. Deflation, similarly, a low level of inflation. That happened just 7% of the time. That's typically a recessionary environment, which is probably what you'd expect, not very often, but unhelpful when it does happen. But in this environment, your bonds are working for you, your income assets are performing, and your equities are not really helping, but they're not hurting you too much either. So in aggregate, these bottom 2 quadrants, inflation below 2%, the data is telling us actually that a balance of growth assets are working and building a balanced portfolio is pretty straightforward. Now, of course, the interesting bit, and what I want to tell you about, is the top half of this quadrant, because that's when you've got a floor of 2% and inflation is at or above it. Now, the left-hand side, you've got an environment of disinflation. That happened 40% of the time over those 100 years. Inflation is high, but it's falling. And that's quite clearly what we've had over the last 18 months or so. And that recent experience is pretty aligned with this data. You've got a positive correlation between bonds and equities, but it's a helpful one. They're both delivering returns in a balanced portfolio. Unsurprisingly, where the rubber hits the road is the top right-hand side, when you've got high inflation and it's rising. This happened 20% of the time over those 100 years of history, and basically this is 2022. You've still got a positive correlation between bonds and equities, but they are falling together, and clearly that is what we experience as investors in 2022. So in these top 2 quadrants, which is where I think we're going to be spending most of our time in the coming years, achieving diversification with a conventional asset allocation, as the data demonstrates, is actually quite tricky. So what does work? Well, they found that a bucket of assets, which they described as diversifiers, which should be coming up on my slide. No? There you go. Were really the key here. So they delivered a good positive return in an environment where bonds and equities were falling. And actually, they didn't hurt you too much in that disinflationary environment. So there's some nice asymmetry there from owning these diversifiers. Now, crucially, what are they? They are precious metals, we mentioned gold, and also industrial metals. They were the standout asset class in that environment. So looking at this sort of holistically in aggregate, if we are going to be living in those top 2 quadrants, if there's a risk that 2% is the floor, not the ceiling, and that happened 60% of the time over these 100 years, and a third of that time was an environment where conventional portfolios struggled, I think it's really important that we review how we're building portfolios, not reinvent the wheel, but perhaps look through a slightly different lens, and it's going to require different asset classes, commodities, but also we can see that things like derivatives, currencies play an important role here, and arguably investors have much less, very little, or even no exposure to those types of assets. So that's a lot of theory, a lot of data, I'm conscious. So let's look at some recent reality to finish up, and I want to highlight a few other points. Left-hand side, we can see that 2022 saw double-digit negative returns for growth and income assets. That's what the left-hand chart shows us. On the right-hand side, it shows us the need for those diversifying asset classes, commodities and derivatives in particular having played a really key role in the Ruffer Investment Company portfolio that year. I think it tells us that reality is that investing is going to be a bit less straightforward in this new regime. It is going to require the use of more complex instruments, but they can be used to good effect. What it also tells us, though, is I don't think the answer is simply just to buy and hold some of these diversifiers, because as you can see, again, on the left-hand chart, in aggregate, diversifiers also lost money in 2022. It means that dynamic, active management is going to be required because different flavors of diversifiers are going to work at different points in time. Going back to the academic work, for example, gold on its own was the single best performer across those high and rising inflation regimes. I think it annualized about 13% return, but it was actually only a positive return in 2/3 of the time that you had high and rising inflation. So complex assets are going to be necessary. It may lead investors perhaps to more specialist managers, and an active, dynamic approach needs to be employed. And that's what we're trying to do at Ruffer. Our aim is to deliver a consistent positive return, regardless of what's going on in markets, and we do this by focusing first and foremost on the risks, and we also make use of our flexible multi-asset and crucially unconstrained approach. It's our long-term performance chart. It spans 30 years. It's our 30th birthday this year. Not many single strategies make it into their 4th decade, but I think we have, because in each crisis in markets that we've experienced through our history, and they're the green shaded areas on this chart, we have protected and grown investor capital. I think it's because we very much have an appreciation of history, but also an imagination for the future and an understanding that asset class correlations can change. And each of these crises through which we've protected and grown investor money, a different toolkit's been required. That flexibility, that willingness to adapt has been, I think, the secret to delivering equity-like returns over this period, but with bond-like volatility. And how we've acted perhaps as a useful part of investor portfolios, delivering that protection in the tricky periods, protecting against risks in markets, but also capturing opportunity when maybe others are fearful. Well, very briefly, I'll show you the Ruffer Investment Company portfolio as it looked at the end of last month. I'm very happy to then take lots of questions. Our inflation protection is in green here. It's a combination of different things, so that basket of different protections is going to be really key. Inflation-linked bonds, they will benefit, we think, when the market perhaps shares our view that long-term inflation expectations should be higher. We own ultra-long-dated index-linked bonds in the UK. We've got a basket of precious metals exposure, some gold equities, but also some silver and some platinum. There's also some inflation protection in the bucket on the right-hand side. These assets have roles to play in the short term, but I think they'll also help us when we get this regime change. Commodities, as clearly the data showed, direct exposure to copper and oil at the moment. We've also got some commodity equities, names like BP and Rio. And in the middle, you've got that derivative protection, which is going to be really important if we get a sell-off from those all-time high equity valuations. And again, if we experience a year like 2022, when they were the key driver of our returns in the portfolio. I'll just flag, there's obviously a significant portion of short-dated bonds, which are effectively, these are cash proxies in the portfolio, so very short-dated government paper, yielding a sort of 4 or 5%. Probably not what you'd expect to see in such a large proportion if I'm talking about inflation and the risks of that. But that's really the intersection in the Ruffer portfolio of our long-term structural views and our tactical views. It's a function of how we construct portfolios. I think we can identify what the biggest risks are to investors. Clearly, we've been talking about that today in the form of inflation. But I don't think we know when that's going to be crystallized by investors and by asset prices. So it's really key that we've got other assets in the portfolio around that inflation protection that can help us to achieve and deliver good positive returns in the interim while we wait for that moment to arrive. As I say, our cash assets yielding us 4 or 5% without taking on any additional risk is very appealing in the current market environment. And I think there's a lot of money to be made if we do get downside outcomes in the near term from the yen and also from that derivative protection. And you started to see glimmers of that at the start of August. I'll leave it there with a summary. New inflation regime. Investors need to be thinking about different ways of approaching asset allocation, but there is a solution, and let's focus on the data-driven ones. And I'll happily take questions.
Thank you very much, Jasmine. So we have About 10 minutes left for questions, and I can see we already have one at the back there. If you could just wait for the mic before you ask the question, that would be perfect. Thank you.
Hello. You touched on quite a lot of different asset classes, etc., but you haven't mentioned crypto. Is that going to magically come to the rescue of various difficulties?
Bitcoin, the first question. For those of you who know Ruffer, we have historically had a position in Bitcoin, which again might be surprising or unusual for a strategy that first and foremost focuses on capital preservation. So exactly to your point, at the end of 2020, we started to think or look at our inflation basket protection. If you've got gold, which historically has been a very good inflation hedge, if you've then got the index-linked bonds, which you could describe as maybe 21st century gold, is Bitcoin crypto going to start to become digital gold? We took a position in Bitcoin, a very small one in the portfolio, about 2.5%. With that being part of the thesis, potentially it starts to get viewed as a true store of value and a sort of iteration of gold and linkers. The other element, though, to that allocation was really about adoption. So Bitcoin was clearly becoming the winner in the crypto space, and you started to get a lot of infrastructure built around it, both on the regulatory side and also the product side, and you started to see institutional asset managers looking at it and being willing to own it. So that position was initiated when Bitcoin was about $15,000. We rode it all the way up to sort of $60,000 at its peak. We took out our initial capital multiple times, so it was a very attractive and successful trade in the portfolio. We ended up fully selling out of it, though, because that part around institutional adoption had played out. That's really what drove the price rises, not it behaving like a digital gold. And it started to behave like a very frothy, sort of liquidity-driven asset class. And I don't think that has changed. It's not never say never. I think it's still interesting to observe and to watch. Maybe one day it does reassert itself as a digital gold, but at the moment it certainly doesn't behave like it, and therefore we don't own it in the portfolio.
Great. We have one question at the front here. We've also got a number at the back, which I have seen, so we will be coming to you in 1 second. Yes, thank you.
Hi, thank you for a really interesting presentation. Could you go back on your slide presentation to the, the bit where you were pressing the button on the diversifiers? Could you show that slide?
Apparently
maybe
I can't go backwards, but
oh, okay.
maybe they can.
Oh. And I was going to ask the question, no, can you put those in? What happens,
What happens in the bottom quadrant?
Yeah, what happens if I hate to say it, but if you're wrong,
Yep.
and I diversify, what are the numbers?
4%.
What?
In both deflation and reflation, diversifiers did about plus 4% in both.
Oh, okay.
So, okay, giving you an okay positive return.
Okay, and how will you know whether your hypothesis, as it were, is correct? You said a number of times, I think you said, we'll know whether it is 2%. I don't want to quote you, but you sort of implied that we'll know.
Yep. So there's the reality of the data. What does inflation look like? Will we get another wave of inflation? But also asset pricing. So a good way of knowing that investors don't share this view is by looking at long-term inflation expectations, by looking at inflation-linked bonds, break-even pricing. We can talk about that later. But basically, if you look at asset pricing, you can see that investors only expect inflation to be 2% on a 2-year view, on a 5-year view, on a 10-year view, on a 30-year view. If and when those break-evens start to move up, i.e. market pricing of long-term inflation starts to increase, that tells me that investors are starting to share this view, and you're going to see that reflected in asset prices like the index-linked bonds. They will make money in that environment.
Excellent. So we have a few questions at the back. I'm really keen to take them. Yes, thank you.
Okay, my question was also about index-linked bonds, but maybe you can just expand a little on the point you were making there, because it seems to me that just as an impression, as a long-term holder of your company, that you've been rather, I don't know whether you've been shocked, but certainly there's been quite a big penalty to owning long-dated index-linked and TIPS as well in the past 2 years. They're recovering a bit now, but they've been. Have you been disappointed? What do you think I seem to remember, possibly before you joined Ruffer, that there was an interesting article that maybe Jonathan Ruffer published about what would index-linked gilts have yielded if they had existed during the inflationary episode of the 70s. And it was one of the key reasons, I thought, why you were investing in them. And I just wonder now whether you're revisiting that point and wondering whether you were correct.
Yep. So absolutely right to point out, in 2022, when you did get multi-decade highs of inflation, index-linked bond prices almost halved. So they did not provide that protection. Now, in the portfolio, we had other assets that offset those losses, so we were still able to deliver that positive return. But yes, I think it did surprise us. Now, the reason those index-linked bonds that we own, the very long-dated, ultra-long-dated index-linked bonds in the UK, didn't perform well, is because they reflect, and this slightly comes to this gentleman's question, they reflect investors' long-term expectations for inflation. If you own index-linked bonds at the very short end of the curve, they will reflect realised inflation, so they would have performed much better. But we hold them still, despite them not yet having worked, because I do anticipate that if we get secondary and maybe tertiary waves of inflation, investors will change their view and they will start to appreciate that perhaps this inflation isn't transitory, that they do need to find ways of hedging themselves against longer term, more structural inflation. And that's when those bonds I would expect to appreciate in value, because they are one of the few asset classes that will provide you with that protection alongside things like commodities, gold. But I think it's fair to say it's been surprising that investors have remained this confident that central banks will get us back to 2% and it will stay there.
Excellent. We've got a question to come here through from someone in our online audience. They say thank you very much. What is your view on UK rates for the third quarter of 24 going into 25, given increased tension in the Middle East? I'm sure we'd all like to know the answer to that.
Gosh. Look, again, when we build portfolios at Ruffer, and I'm just going to preface this before actually answering the question, we don't try to make specific judgments around things like interest rates, because I don't think it's possible. Clearly, as investors, we're going to be surprised all the time. I think the UK is interesting, though, because you have had a lot stickier inflation, and particularly if that's coming at a time when you've got quite powerful disinflation in places like Europe in particular, but also the US, that's going to start to impact the currency. So I would expect rates potentially to stay higher in the short term in the UK relative to the likes of Europe and the US, and the knock-on impact that perhaps has on sterling.
Excellent. Well, thank you for giving us a prediction, because not many people will do that. There's a question at the back. Thank you.
Thank you very much. Ruffer has an excellent, very long-term investment performance track record, but in the more recent past, it's been less impressive. Can you explain the reasons for the falls in NAV over the last 18 months or so, and what, if anything, you've done to address that?
Yep, absolutely. So very right in saying so. 2023 was very disappointing for us. That came down to balance in the portfolio. So we lost money in our protective investments, primarily the derivatives and the yen. So almost the complete opposite of what delivered the good returns in 2022. That, I say, was expected, though. They behaved as we would have anticipated in a rising equity market, as we had last year. The derivatives and the protection assets lost us money. What was frustrating, and what we really did get wrong last year, was not having the right offsets on the other side. So we didn't have enough in equities, and we didn't have the right flavour of equities, and commodities was another part of that offset. They didn't behave in the way that I would have anticipated. So we had cyclical equities and commodities because of the view that if we didn't need protection because economies weren't going to break under higher rates, then it's because economic growth is going to surprise to the upside, and you would expect that to be reflected in cyclicals and commodities. But it wasn't. And you had a very, very narrow equity market rally last year. So the balance wasn't quite right. We've addressed that, and I think it's reflected in the fact that we have delivered 5-6% over the last 12 months in NAV terms, while still holding a lot of that protection. But we've been much better in balancing that with our offsets. So hopefully the more recent performance reflects us addressing the mistake that we made last year.